Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
I find, rather than using trend lines, and particularly in a market extremely volatile, I find the use of a double moving average crossover be a little bit more and a little bit more. It flows a little bit better with the bullet section. So I have here a snapshot of the BPX, and in fact the BPX is actually trading right up here as of today. We had a break above this moving average here, but ultimately what we would be looking for is, as you can see here up in the top left-hand corner, when the 8-bar moving average, which is the shorter average, crosses over the 21-bar moving average, have here in red. That's essentially a short-term trend, a crossing over term trend. So it means that there's essentially a change taking place. And ultimately, you can look at that crossover, and we can see that in this particular result, we didn't see a change in that particular, so in other words, the blue line remained below the red line, all the way from approximately 64 all the way down to 62. But a 2-point move in this particular area before the moving averages actually ever gave us any sign that there was a change. So what happens is that the moving averages, in fact, the approach to using moving averages is very simple. Really what we're doing is we're plotting a line that is averaging out the last, in the case of the 8-bar moving average, that's 8 bars. And so that line is being plotted, and think about that each bar, there's a dot. In other words, every day an average is being calculated and a dot is being there. All these moving average lines do is simply join. So every day there's a new average calculated and a new dot on that particular day. All right, and it's as simple as that. So the 8-bar moving average serves to hug the price action or the pair value action more closely, and it's giving us some inclination to shorter term trading activity. The 21-bar is averaging a longer period of time. So it's a little slower. It's considered a slower moving average. So when the 8-bar or fast moving average breaks over below the 21-bar, which is a slower moving average, it gives us a sight suggesting that, all right, there's a change in direction taking place. Now, sometimes we have some very quick as the pair value tries to establish its bias. Ultimately, you can see here we have a move from 62 down to 1, and then so on and so forth. Okay. And right now you can see that for all intents, the moving averages are still crossed down. But as I said, today we get a little green bar that's poking up above that 21-bar moving average that said, okay, maybe there's a little bit of a change in place. So Andrew, I suggested that it's the MACD in drag or lag, ultimately is what his suggestion is, and yeah, that would be an appropriation. But again, for people that are not quite in tune with the levels of technical analysis, what we want to do is we just want to create some simple guidelines to get out. So, in other words, from a strategy selection point of view, when moving averages are trending down, we want to focus our strategies to be, when moving averages are trending up, we want to focus on more bullish. Now, the question here from Mike is, in my experience, which pairs seem to trend for longer here? Are you referring to the moving average pairs? If that's the more time we allocate to each one of the moving averages, the longer trends are going to stay in place. So ultimately, what we want to do, and guys, I'm hoping, did I lose audio here? Maybe just a confirmation as to whether or not I lost audio here. Oh, am I back?
Yep, I think you're fine.
Okay, great. Thanks, guys. I thought for a second that I'd lost audio, so I appreciate that there. So anyways, guys, the 8 and 21 moving averages for my style of trading give me a sufficient enough time frame in which to take advantage of trends that are in place for perhaps days to a few weeks. Okay, and that means that I'm a little bit more active. For somebody that wants to be a little bit more active, you can utilize a longer-term set of longer-term moving averages. But what we have to recognize is the longer the time frames we have, the more price action is going to take place, or the more action on those pair values as they trade on a day-to-day basis. One day you might be up quite a bit, the next day you might be down quite a bit, and you have to, because you're going for a bigger picture trend, that the fluctuation is going to be a little bit more significant. Sorry, Mike was actually referring to which would be better to look for trending opportunities. For the most part, really the most significantly trending pair right now has been the U.S. dollar Swiss, as we looked at earlier on. Other pairs, and I'm going to use them as examples here in a few moments, all seem to be very much, consolidating within a tradable range. Don't get me wrong, but ultimately, the couple of months have been very much range bound as the world tries to figure out just what the heck is going on with self-economic perspective. So again, really, if you're looking for the establishment of a longer-term trend, what you can do is you can look at, instead of a daily chart, look at a weekly chart. So you can actually still use the 8-to-1 moving average combination, but put your charts on a week frame. And hopefully, guys, if we have time towards the end, I'll be able to pull up my real charts, and you guys can have a look and see what I mean based on today's trading activity. But the other consideration that we want to make is, of course, the idea of understanding support and resistance. And support and resistance is very simply the identification of strength and weakness at certain price levels. The lows are considered support, highs are considered resistance. So here we actually have the CDD, and this is a reflection of the pair testing the support level. Now, right at this point, we actually finally tested par for the U.S. dollar versus the Canadian dollar, and that's actually been reflected in the price chart. With a little bit of a pullback, but we're actually right back up in this zone as of today. So we can see here, back right in this level here, we had our moving average crossover. So here's the thing, guys. This is what we want to try to start doing. We see a support level down here that says, okay, we're starting to see some support down at this 94 level, a little bit of an indication that perhaps we should see a trend, in this case a big downtrend, perhaps maybe make a decisive change in another direction. So that would be one indication. Here we have that crossover of the moving averages, and at this point, right now, the CDD, which is reflecting U.S. dollar strength against the Canadian dollar, is trending to the upside. Now, my challenge when we talk about support and resistance is that we actually have a fairly significant resistance level in this zone right in here. So for me, what I would want to look for is look for a pullback, look for a break above that resistance level, and now that resistance level becomes support, and we can use that as a springboard to perhaps take advantage of a continuation to the upside for this particular pair. So we're always and consistently looking at a number of different variables in order to help us with our trade entry decisions. But utilizing just the simple concepts of support, resistance, and trend identification opens up the window for us to be able to establish some opportunities, or at least, as I mentioned in the introduction, be a little bit more strategic about our entry. So in other words, we want to be cautious after such a big move that there's not what we refer to as a little bit of a retracement. We want to wait for that retracement to take place, and then we can perhaps take advantage of a continuation in our anticipated direction. And that outlook is simply just utilizing the principles of trend identification and support and resistance. Now, if we look at the idea of resistance, here's the EUI, which is the U.S. dollar versus the euro, and you can see here that I've drawn in this 71 level as a key resistance, and we can actually look at the previous test down here, and you can see that it was resistance for a bit of a bounce, a little bit of a slice through, but for the most part, there was the pair value held at 71 and then bounced higher. Came back down, you'll notice there was a bounce off of that level again. That previous level became resistance and remains resistance to this day. So to consider, remember my first example of a trend identification was utilizing these lower support level, or these lower pivot points here, and saying, okay, we may have an uptrend in place. The next clue that I want to see is a break above resistance. So clue number one, hey, maybe there's an uptrend being established here for the U.S. dollar against the euro. Clue number two is, and I'll illustrate this moving forward, is, hey, once it breaks above 71, that may be the signal for continuation to the uptrend. Might be time to buy some calls or create a call spread of some sort in order to participate in that. But for now, this kind of range-bound activity does not bode well for an option buyer. So again, another indication as to how we can use the price charts for strategy selection. Think about how an option contract is going to respond with the market, with its pair value going down, going up, going down, going up. Every single day, it's getting turned and it's getting burned by that concept of time depreciation. So this is something we need to be very, very sensitive to. So let's look at strategy selection for bullish directional trades, and we'll take a look at a couple of very simple ways that we can take action here. Here's the British pound, the BPX. And the consideration for perhaps buying some call options on this particular pair. Well, we can see here just inside that circle where we have a little bit of consolidation in the price action, and we in fact have a little bit of a support level coming here that's suggesting, hey, you know, maybe this pair does not want to sell off anymore. So maybe the U.S. dollar wants to regain some of its ground against the British pound. What we can do is we can look at a very short-term resistance level, or a short-term pivot point, if you will, which sits right in here around that 61.50 level. Now, at this point, our moving averages haven't quite crossed yet, but what we would look to do is as the pair breaks above that level, we would look to buy call options to ultimately capitalize on that move. Now, what we can do is we can go to previous resistance levels, and we could say, okay, this would be a logical target to ultimately lock in some profits, and if we exceed that, here's another short-term target, and if we exceed that, here's another short-term target. So what we've done is we've gone back and we've used short-term resistance levels or previous resistance levels as targets to establish points of action for our trade. Now, Mike, just to answer your question, the moving averages that I'm utilizing are exponential moving averages. I like a little bit more weight on the near-term price action. That's more so what my concern is what's happening within the last couple of days. So an exponential moving average places more weight on the near-term bars versus a simple moving average, which calculates the average equally across all of the various bars under calculation. So again, here's just a very simple approach to buying call options. Now, call spread, exact same observations. We want to determine whether or not we're bullish or bearish. In this case, we're bullish. We're going to look at the same consolidation within that zone. We're going to look at that same potential entry level and buy calls here. But at the same time, because options are expensive and because we see that there's a fairly significant resistance level up here at the 60 to 50 zone, we might consider selling calls off in that range. And then ultimately what that means for us is that we're going to capture the difference between these strike prices minus the premium that we've paid. So what this bull call spread does for us is it allows us to acknowledge, of course, the potential for range-bound trading activity. It allows us to collect the premium in the event that the options are expensive to offset the cost of our long positions. When we lower the cost of our long position, we lower the break-even point and we lower our risk exposure. So these spread strategies become a very good consideration in a market where you want to take action, you want to take advantage of a particular directional bias, but at the same time you're a little concerned about the uncertainty that has been quite evident over the last several months.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.